Hello everyone, Jordan Coons here. I'm here with Charles Kayataba, and we're going to be covering the three main topics when it comes to getting a mortgage in Ontario. Charles?
Well, I just want to take the time and say thank you, Jordan, for letting me speak to your audience and network. As Jordan said, my name is Charles Kayataba. I'm a mortgage and lending specialist with Mortgage Architects. I deal mainly with residential and commercial.
Amazing. So what we want to cover today, as I said, with getting a mortgage in Ontario, let's just start from the beginning. If I want to get a mortgage and I'm thinking about buying my first property, where do I start, Charles?
Well, there's a few different points you want to look at. Obviously, the first thing you want to do before you go and talk to Jordan or your expert realtor in the area is understand what you can qualify for in the form of a pre-approval, right? Mm-hmm. And there's a lot of different factors that you want to take into consideration when getting that pre-approval. So as a mortgage specialist, the main things that I look at, all right, is A, credit. Because obviously knowing that if the credit score isn't there, we really don't have a deal, or we have to look for other lending options, right? Now, if you're looking to get in with some of the larger lending institutions, so like the TDs, the Scotias, and some of those bigger A banks, generally they want to see around 650 plus, all right, okay, with the credit score. Number two is income, all right? Are you employed? And what type of income do you receive? Are you a salaried employee, all right? Are you an hourly employee? Straight commission, self-employed, all right? Are you a business owner? Because that's going to dictate what documents I need to collect in order to give you, in order to evaluate your income and how much borrowing power you actually have, right? And then last but not least is your down payment. All right, so naturally, first-time home buyers or anywhere in Canada, you are allowed to put a minimum of 5%. All right. Obviously, if you're buying an investment property or things of that nature, naturally they want to see 20% down, right?
Okay, and then I guess a lot of people have kind of discussed the thoughts of if I don't have the 20% down, what happens?
Yeah. So if you're buying a primary residence, all right, you can get a gifted down payment in the form of a gift letter from an immediate family member. All right. Mm-hmm. So immediate family member being like brother, sister, dad, maybe grandparent, right? In some occasions, all right, you may get an exception depending on the occasion. It could be like a outside family member, so like a distant cousin or something like that, but that's far few in between. Mm-hmm. Generally, they want to see it coming from directly an immediate family member. Also, with the down payment, all lending institutions are going to ask for a 90-day proof, all right, okay, of bank statements or where that's coming from. And simply that's just to protect themselves against any type of anti-money laundering and compliance.
Okay, so let's break down a mortgage. In terms of understanding, I want to know the rate, I want to know amortization.
Nice.
And I want to know just, all the components that go into getting a mortgage.
Okay, beautiful. So first off, I'll answer your first question. What is a mortgage, all right? A mortgage is simply just a loan from a bank to allow a borrower to buy a property, all right? A physical property or land, all right? Now, that's why it's called a secured debt, because essentially that dwelling, so that property or land, is held in collateral, right, with the bank. So in case any missed payments were to happen along the term, then the banks will technically have the right to actually foreclose the home and take the property.
Okay. So Charles, can you explain to me a little bit more about rates?
Yeah, 100%. This is definitely a hot topic right now, right? So you probably already know fixed rates are a little bit on the rise again.
Yeah.
Variable rates have stayed pretty steady. When it comes to purchasing a home, you have two options, right? You can go with a typical 5-year fixed or 5-year variable. Now, one is not better than the other. It's really what's your taste for a little bit of risk, all right? Now, naturally, fixed rates are a little bit more elevated, all right? So you will be paying a slightly higher P&I payment, principal and interest, but your rate is not subject to change at all. All right, throughout your 5-year term, 4-year term, or whatever term you're locked into. All right, that's going to stay static. All right. Now, when it comes to variable, yes, variable rates tend to outperform and are a little bit lower than the fixed rate, but it is subject to change based off of the Bank of Canada's qualifying overnight rate. All right. So that is something that people don't necessarily like. The idea of their rate having the potential to change depending on what economic factors or conditions are going on in the outside world, which is why actually 85% of people, 85% of home buyers, I should say, actually go with a fixed rate over a variable.
Awesome.
Yeah.
That's great tips. Charles, so you mentioned term a lot when you were talking about rates. Can you explain that some more for us?
Yeah, no, not a problem, Jordan. So a term is pretty straightforward, excuse me. So whenever you go and you get that mortgage, you have an option in terms of the term. So that's essentially how long you are binded to that legal contract, right? So generally a term can range really anywhere between 6 months to 5 years. Now, most people like to sign a 5-year term, right? In 5-year increments, it's just a little bit easier to plan and organize, right? So again, the term is just what you're locked into. So the terms and conditions of the mortgage commitment that you sign when it comes to your rate, your loan amount, breaking penalties, all that fun stuff, all right, is locked in for that term. And then you have the opportunity to renegotiate new rates, if you want to ask more in a refinance, if you want to pay off a little bit more, etc., at the end of that term.
Okay, and what I know about it is there's an amortization, right? So when it comes down to amortization, you're talking about 6 months to 5 years in terms of terms. What happens, or how do we explain an amortization to everybody? Right.
So amortization is a pretty straightforward concept. So all that is you take the loan amount. All right, and if you're given a 25-year amortization, that's just how long it's going to take for you to pay that loan amount down to zero. All right, now within those 25 years, all right, you have 5-year terms or 4-year terms, etc. So that way, every 4 or 5 years, you can renegotiate. All right, you have the ability to renegotiate the terms of that legal binding contract. That's exactly what a mortgage statement is, right?
Yeah.
So whatever the balance, whatever loan you have, your amortization is how long it's going to take you to pay that loan down to zero.
Wonderful. And then you own it in full.
And then you own the house free and clear.
Thank you so much for joining today, and I appreciate you guys watching and supporting us. If you got some useful tips today, please like, comment, share with all your friends and family. And if you have any real estate questions, give me a call at 905-371-6112. I'm going to let Charles end it off. Thanks, guys.
All right, thank you for everyone who tuned in and watched this video today. I hope you're able to take home some golden nuggets. Quick shout out and thank you to Jordan and the Revel Real Estate team for allowing me to speak to your network. If you're looking to get in contact with me directly and speak or talk about anything mortgage related, please feel free to give me a shout at 905-246-8799. Cheers.